Okay, and welcome to a brief video on short-term bank loans. This one happens to be interest-bearing as opposed to a non-interest-bearing note. We'll talk about those in a moment. Well, here's the facts. On October 1, 2023, Schaefer Tool & Die borrowed $100,000 from a bank and issued a 9-month 12% promissory note. Interest on the note is payable at the June 30, 2024 maturity date. So on June 30, we will repay them the $100,000 and the interest on the note. And I wanted to point something out that the interest on the note is at 12%, but that's an annual rate, stated annual rate. And so it would be $12,000 per year, but we're only going to have the bank's money for 9 of the 12 months of the year. So we multiply that times 9/12, and we will only owe them $9,000 of interest. Okay. So at this point, as always, I hope you'll pause this video. And now, if you haven't already, work the case and then come back and watch the video and verify that indeed you did it correctly. Okay, see you in a moment. Okay, welcome back. And here's the solution to that case. So on October 1 of 2023, we went to the bank and we borrowed $100,000. So the bank gave us $100,000. We signed an agreement to repay them the $100,000 in 9 months and also pay them interest. And so at this point, we're increasing cash, an asset, by $100,000, and we're increasing our liabilities because we now owe a bank $100,000. And at this point, the primary thing we're doing is we're out using that $100,000 to finance the project that we told the bank we were going to do, and hopefully that'll make us a bigger, more profitable company, and we'll pay the bank back their loan and its interest. Now, we come to the year end, and among the economic events that have happened that we haven't captured is the accrual of interest on that bank loan. And so at year end, among our adjusting journal entries is one to recognize the interest for October, November, and December, 3 of the 12 months, or $3,000. We increase the interest payable by $3,000, and we also increase the expense by $3,000, interest expense. So now on the balance sheet related to this loan at December 31, 2023, we're going to report a note payable of $100,000 and interest payable of $3,000. Ultimately, we will pay $9,000 of interest, but that's going to occur in 6 months hence. Now, 6 months hence goes by. And indeed, we pay the bank the $109,000. What's that $109,000 for? Well, it's $100,000 to repay the principal of the loan. It's $3,000 of it is the interest we accrued at the end of 2023, and $6,000 is the interest that we accrued in 2024. January, February, March, April, May, and June. All right. And that is accounting for a short-term bank loan. Again, the accounting's pretty easy. The hard part is using that money well to build our company and make us more profitable and more successful. All right. Thank you for your attention. And I will see you on a brief video when we talk about what if that note were non-interest bearing.